Starting a business is an exciting journey, but one of the biggest challenges entrepreneurs face is securing the right funding. In this video, we'll walk you through the various funding options available for startups, helping you understand what might be the best fit for your business idea. Whether you're just at the concept stage or ready to scale, knowing your funding choices is crucial. Let's begin by exploring why funding is so important and how it can impact your startup's growth trajectory. By the end of this guide, you'll have a clearer picture of the funding landscape and how to navigate it. Funding is the lifeblood of any startup. It enables you to turn your ideas into reality, build a team, develop products, and reach your target market. Without adequate capital, even the best ideas can struggle to get off the ground. Funding also provides a safety net, allowing you to experiment, iterate, and grow without the constant pressure of running out of resources. In this scene, we'll discuss the key reasons why startups seek funding and how it can make the difference between success and failure. Bootstrapping means funding your startup using your own savings or revenue generated by the business. Many founders start this way, relying on personal funds to cover initial expenses. Bootstrapping allows you to retain full control over your company and avoid debt or giving up equity. However, it can also limit your growth if your resources are limited. We'll look at the pros and cons of bootstrapping and when it might be the right choice for your startup journey. Another common early-stage funding source is friends and family. This involves raising money from people you know and trust, often in exchange for a small equity stake or as a loan. While this can be a quick way to secure funds, it's important to set clear terms and expectations to avoid misunderstandings. We'll discuss how to approach friends and family for funding, the potential risks, and how to maintain healthy relationships throughout the process. Angel investors are individuals who invest their own money in startups, usually in exchange for equity. They often bring valuable experience, mentorship, and networks to the table, which can be just as important as the funds themselves. Angel investors typically get involved at the early stages, helping startups get off the ground. In this scene, we'll explain how to find angel investors, what they look for, and how to make your startup attractive to them. Venture capital (VC) firms invest larger sums of money in startups with high growth potential, usually in exchange for equity. VC funding can accelerate your growth, but it also means giving up some control and meeting high expectations. Venture capitalists often provide strategic guidance and access to industry connections. We'll break down how VC funding works, what VCs look for in startups, and the typical stages of venture capital investment. Seed funding is often the first official round of investment for a startup. It helps founders develop their product, conduct market research, and build a team. Seed funding can come from angel investors, seed funds, or even crowdfunding platforms. This stage is crucial for turning your idea into a viable business. We'll discuss how to prepare for seed funding, what investors expect, and how to use these funds effectively. As your startup grows, you may pursue Series A, B, or C funding rounds. Each round is designed to help you scale further, whether it's expanding your team, entering new markets, or developing new products. These rounds typically involve larger investments from venture capitalists and sometimes corporate investors. We'll explain what each funding round means, what milestones you need to hit, and how to prepare for these stages of growth. Crowdfunding allows startups to raise small amounts of money from a large number of people, usually via online platforms. This method not only provides funding but also helps validate your idea and build a community of early supporters. Popular crowdfunding platforms include Kickstarter and Indiegogo. We'll cover how to create a successful crowdfunding campaign, the types of crowdfunding, and the benefits and challenges of this approach. Many governments offer grants, loans, and support programs for startups. These funds are often non-dilutive, meaning you don't have to give up equity. However, the application process can be competitive and time-consuming. We'll discuss how to find relevant government programs, what types of support are available, and how to increase your chances of success when applying for grants. Additional bank loans are another funding option, though they can be harder to secure for early-stage startups. Banks typically require a solid business plan, collateral, and a good credit history. While loans don't require giving up equity, they do come with repayment obligations and interest. We'll explain the pros and cons of bank loans, how to improve your chances of approval, and what to consider before applying. Incubators and accelerators provide startups with funding, mentorship, and resources in exchange for equity or participation. These programs often last a few months and culminate in a demo day where startups pitch to investors. Being part of an incubator or accelerator can open doors to valuable networks and help you refine your business model. We'll look at how to apply, what to expect, and the benefits of joining these programs. Some large corporations invest in startups through their own venture arms. Corporate venture capital can provide significant funding and access to industry expertise, but may also come with strategic interests that influence your business direction. We'll discuss how corporate venture capital works, what companies look for, and the potential advantages and drawbacks for startups. Forming strategic partnerships with other businesses can be a creative way to access funding and resources. These partnerships might involve co-development, revenue sharing, or joint ventures. By aligning with established companies, startups can leverage shared expertise and market access. We'll explore how to identify potential partners, structure deals, and ensure mutual benefit. Revenue-based financing allows startups to raise capital in exchange for a percentage of future revenues rather than equity. This can be a flexible option for businesses with predictable income streams. Payments adjust based on your revenue, reducing pressure during slow periods. We'll explain how revenue-based financing works, its benefits, and when it might be a good fit for your startup. Convertible notes are a form of short-term debt that converts into equity at a later funding round. They are popular in early-stage fundraising because they delay the need to value the company. Investors provide a loan which is later converted to shares, often at a discount. We'll discuss how convertible notes work, their advantages, and what founders should watch out for. Safe, simple agreement for future equity agreements are a popular alternative to convertible notes. They allow investors to buy equity in the future without accruing debt or interest. Safes are straightforward and founder-friendly, making them common in seed rounds. We'll explain how safes work, their key features, and why many startups and investors prefer them. Choosing between equity and debt financing is a major decision for any startup. Equity financing involves selling shares of your company, while debt financing means borrowing money to be repaid with interest. Each option has its pros and cons, affecting control, risk, and long-term growth. We'll compare both approaches, helping you decide which aligns best with your goals and business model. You raise money by selling equity. Your ownership stake in the company decreases, a process known as dilution. While dilution is a normal part of fundraising, it's important to understand how it affects your control and future earnings. We'll break down what dilution means, how to calculate it, and strategies to manage it as your startup grows. Valuation is the process of determining how much your startup is worth. It plays a critical role in fundraising as it affects how much equity you give up for investment. A higher valuation means you can raise more money for less equity, but it must be justified by your business's traction and potential. We'll explain how valuations are set, what factors influence them, and why getting it right is so important. Compelling pitch is essential for attracting investors. Your pitch should clearly explain your business model, market opportunity, team, and how you'll use the funds. Storytelling, data, and confidence all play a role in winning over investors. We'll share tips for crafting a strong pitch, what investors look for, and how to handle tough questions during presentations. Solid financial model helps you plan for the future and demonstrate your startup's potential to investors. It includes projections for revenue, expenses, and growth. Investors use your financial model to assess risk and return. We'll guide you through the basics of building a financial model, what to include, and how to make your projections realistic and compelling. Raising funds involves important legal steps, from drafting agreements to complying with regulations. It's crucial to work with legal professionals to protect your interests and avoid costly mistakes. We'll discuss key legal documents, common pitfalls, and how to ensure your fundraising process is smooth and compliant. For investing, most investors conduct due diligence to verify your business's claims and assess risks. This process involves reviewing your financials, legal documents, and business model. Being prepared for due diligence can speed up the funding process and build investor trust. We'll explain what to expect, how to prepare, and common areas of focus during due diligence. Negotiating funding terms is a critical part of the fundraising process. Terms include valuation, equity percentage, board seats, and investor rights. Striking the right balance ensures both you and your investors are aligned for success. We'll cover common negotiation points, how to approach discussions, and tips for reaching a fair agreement. Securing funding is just the beginning. After raising capital, you'll need to manage investor relationships, provide regular updates, and deliver on your promises. Good communication and transparency are key to building long-term trust. We'll discuss best practices for post-funding management and how to keep your investors engaged and supportive. Investors want to know how their money is being used. Tracking your use of funds helps you stay accountable and measure progress. This includes budgeting, monitoring expenses, and reporting results. We'll show you how to set up effective tracking systems and communicate your progress to stakeholders. With the right funding, your startup can scale operations, enter new markets, and accelerate growth. Scaling requires careful planning and execution to avoid common pitfalls. We'll discuss strategies for scaling your business after raising funds, including hiring, marketing, and expanding your product or service offerings. Fundraising is complex, and many startups make avoidable mistakes. These include underestimating how long it takes, not preparing enough, or choosing the wrong investors. Learning from others' experiences can save you time and resources. We'll highlight common fundraising mistakes and how to avoid them on your journey. Beyond traditional options, there are alternative funding sources like competitions, grants, and revenue-sharing platforms. These can provide non-dilutive capital or unique opportunities for exposure. We'll explore some creative funding sources and how to leverage them for your startup's success. Startups aren't limited to local investors. International funding can open doors to new markets and larger capital pools. However, it comes with additional challenges like legal differences and currency risks. We'll discuss how to approach international investors, what to consider, and how to navigate cross-border funding. Impact investors fund startups that aim to create positive social or environmental change, alongside financial returns. If your business has a mission-driven focus, impact investing could be a great fit. We'll explain what impact investors look for, how to measure impact, and how to attract this type of funding. Family offices are private wealth management firms that invest on behalf of wealthy families. They often have flexible investment criteria and can provide patient capital. We'll discuss how to approach family offices, what they look for, and the benefits of partnering with them for your startup's growth. Peer-to-peer P2P lending platforms connect startups with individual lenders willing to provide loans. This can be a faster and more flexible alternative to traditional bank loans. We'll explain how P2P lending works, its advantages, and what to watch out for when considering this funding route. Microfinance institutions provide small loans to entrepreneurs who may not qualify for traditional bank loans. This option is especially valuable for startups in developing regions or those with limited credit history. We'll discuss how microfinance works, who it's best for, and how to access these funds. Some startups secure funding by negotiating favorable payment terms with suppliers or receiving advance payments from customers. This can improve cash flow without taking on debt or giving up equity. We'll explore how to approach suppliers and customers for financing and the benefits of these arrangements. Trade credit allows startups to buy goods or services now and pay later. This short-term financing option can help manage cash flow and support growth. We'll explain how trade credit works, its advantages, and how to build strong relationships with suppliers to access better terms. Factoring and invoice financing involves selling your accounts receivable to a third party for immediate cash. This can be a useful option if you have outstanding invoices and need quick access to funds. We'll discuss how these financing methods work, their costs, and when they make sense for startups. For mature startups, going public through an initial public offering (IPO) can provide significant funding and liquidity. However, it's a complex and costly process with strict regulatory requirements. We'll explain what's involved in an IPO, the benefits and challenges, and when it might be the right move for your business. Mergers and acquisitions (M&A) can be a way for startups to access funding, resources, or exit opportunities. Being acquired by a larger company can provide capital and open new doors, but it also means giving up independence. We'll discuss how M&A works, what to consider, and how to prepare for potential acquisition offers. Having a clear exit strategy is important for both founders and investors. Common exit options include selling the company, going public, or merging with another business. Your exit strategy can influence funding decisions and investor interest. We'll explain different exit strategies and how to plan for a successful outcome. Timing is everything when it comes to fundraising. Raising money too early or too late can impact your startup's success. We'll discuss how to assess your funding needs, the best times to raise capital, and how to align your fundraising with business milestones. Strong relationships with investors can lead to more than just funding. They can provide mentorship, connections, and long-term support. Building trust and open communication is key. We'll share tips for nurturing investor relationships and turning them into valuable partnerships for your startup. Fundraising can be a long and challenging process filled with ups and downs. Staying resilient, learning from setbacks, and adapting your approach are essential for success. We'll discuss how to maintain motivation, handle rejection, and keep moving forward on your funding journey. We've covered a wide range of funding options for startups, from bootstrapping and angel investors to venture capital and alternative sources. The right funding path depends on your business model, goals, and stage of growth. Take time to research, plan, and seek advice from experienced founders and advisors. With the right approach, you can secure the funding you need to turn your vision into reality. Good luck on your startup journey.